The topic that we are dealing with in this presentation is with the relationship between the quantity of money in circulation for a given economy and the general level of stock prices for that economy. The co-authors of the paper are Xiaoxing Song of the University of Newcastle upon Tyne in the United Kingdom, Thieu Phong Trong and John Vanderberg from Victoria University of Wellington in New Zealand, and Mark Tippett of Loughborough University in the United Kingdom. Now, undoubtedly, the two most influential people in this area of the literature have been Milton Friedman and Robert Lucas, both of the University of Chicago, and both of whom have been awarded the Nobel Prize for Economics. Lucas, in his Nobel lecture in 1995, notes that the quantity theory of money applies with remarkable success to co-movements in money and prices generated in complicated real-world circumstances. He goes on to note that the quantity theory of money needs to be a central feature of any monetary or macroeconomic theory that claims empirical seriousness. Now, Lucas demonstrates the empirical validity of the quantity theory of money in terms of the graph that is now set before you, taken from the Federal Reserve Bank of Minneapolis. The x-axis of this graph contains the average annual rate of monetary growth for 110 countries over the period from 1961 until 1991. Likewise, the y-axis contains the average annual rate of inflation for these 110 countries, again over the period from 1961 to 1991. You will note that there is a very tight relationship between monetary growth and inflation. Indeed, Milton Friedman noted that in all of his work that he did on monetary analysis, that wherever he encountered a rapid rate of inflation, it was always accompanied by a rapid rate of growth in the money supply. Probably the most comprehensive empirical study of the relationship between monetary growth and stock returns has been done by Michael Rosoff in his paper entitled Money and Stock Prices. In this paper, Rosoff concludes that a substantial fraction of current stock price change can be linked to current monetary policy. In the paper we present today, we analyse the time series properties of the ratio of the money supply to stock prices. The money supply is modelled by M2, which was Milton Friedman's preferred measure of the money supply, and which encompasses notes, coins, short-term deposits with authorised banks. The stock price index that we use is the S&P Composite Index. Our data covers the period from 1871 until 2018, and we show that the evolution of the money to stock price ratio is compatible with a mean reversion process, that is a random walk process, with a half-life of around 15 years. By half-life, we mean that the ratio of the money to stock prices will converge towards a long-term mean. And when it departs from this long-term mean, it takes about 15 years for the ratio to converge from where it currently is back to halfway towards its long-term mean. Our empirical analysis is based on the widely applied assumption that increases in the money supply occur as a geometric Brownian motion, and therefore in this first equation on this slide, alpha 1, as given here, is the expected rate of increase in the money supply. In the United States, that is about 6% per year over the period from 1871 to 2018, whilst DZ1 is a white noise term and it captures the unexpected increase in the money supply. And thus DZ1 is normally distributed with a mean of 0 and has a variance parameter of sigma squared 1. The solution of the geometric Brownian motion differential equation is well known and is given at the foot of the slide here. The evolution of the stock price index is given by the first equation appearing in this slide. Here, GT, you will recall, is the ratio of the money supply to stock prices, and that ratio has an unconditional mean of mu, as given here. When the money supply to stock price ratio is equal to mu, then this logarithmic term here is equal to the log of 1, which is 0, and we have the rate of increase in the stock price index will be alpha 2 in such circumstances. There will, of course, be a stochastic term as well in all of this, and that's described by the white noise process dz2, and dz2 is normally distributed with a mean of 0 and has a variance parameter of sigma squared 2. Now the parameter b here reflects the higher future expected stock returns which occur when prices are currently depressed, that is, when the money to stock price ratio GT is larger than mu, and the lower future expected stock returns implied by a previously thriving stock market, that is, when the money to stock price ratio GT is in fact less than mu. Finally, we have that the covariance between the stochastic term for the rate of increase in the money supply, which was dz1, and the rate of increase in stock prices, which is dz2, has a covariance of rho 1, 2, sigma 1, sigma 2. Sigma 1 and sigma 2 are the respected standard deviations, and rho 1, 2 is the correlation coefficient between the two white noise processes. We can then apply Ito's formula to show that the evolution of the money to stock price ratio will occur in terms of the first equation given at the top of this slide. You will in fact see that the variance of the rate of increase in the money supply, the variance of the rate of return on the stock price index, and the covariance between them occupies a central role in this formulation of the money to stock price ratio. And it is this ratio, or this expression here, which will in fact form the basis of the empirical work that we report from here on in. One can use the expression that we have just obtained for the money to stock price ratio to determine the mean variance of the logarithmic return on the stock. And you will see from this expression that the money supply occupies an important role in the determination of both the mean and the variance of the rate of return on the stock price, as evidenced by the fact that the expected rate of increase in the money supply, alpha 1, appears in the mean expression for the mean of the logarithmic return, and the variance, sigma squared 1, of the rate of increase in the money supply appears in the expression for the variance of the return on the stock. One can use the expression of the money to stock price ratio that we have just derived to determine the basic regression format for our empirical analysis as given in this slide. Here we define the logarithm of GT to G0 as the logarithmic variation in the money to stock price ratios. And this shows that the logarithmic variation will follow a mean reversion process with a speed of adjustment coefficient of 1 minus e to the minus bt, and it will have a stochastic term of in the form of this integral from 0 to t of e to the minus bt minus sdzs. And the properties of this stochastic term are extremely important. Now, one can demonstrate the importance of this stochastic error term by looking at its variance. Now here you'll remember that B gives the sensitivity of stock returns to departures of the money to stock price ratio from its long-term mean. Now, if T is large and B is positive, you can see that the e to the minus 2bt term will converge towards 0, and the variance of the logarithmic variation in the money to stock price ratio will be stationary. On the other hand, if B should equal 0, then what we find is that the variance of the logarithmic variation in the money to stock price ratio will be non-stationary. That is, it becomes larger with T. And this is tantamount to saying that we have a unit root in our regression equation. And that has very serious implications for the calculations of the T statistics that we report in the standard regression packages. Now this graph is a summary of the annual logarithmic variation in the money to stock price ratio covering the period from 1871 until 2018. And it is this that forms the basis of the first regression analysis that we undertake in our empirical work. So here we have a summary of our basic regression results. The constant in our regression equation is 0.0636 with a t-score of 2.56. The speed of adjustment coefficient, which is 1 minus e to the minus b, is 0.0343 with a t-score of minus 2.28. The adjusted r squared is 0.0279. The Durban-Watson statistic is 1.97 and indicates that there doesn't appear to be any problem with autocorrelation. These results are very similar to the sorts of results that Rozoff got in his study, but I would emphasize that the T statistics that we report here are based on the assumption that B is greater than 0 and are not sufficient, I emphasize not sufficient, to exclude the possibility of a unit root in our analysis. And therefore we need to look at this a little further, and we will do so at a later point in this presentation. And now this slide summarizes in the orange graph the rate of increase in the money supply as measured by M2 on an annual basis. And in blue, we've got the annual inflation rate. And what I find very interesting about this graph is that you can see that there are two periods where there have been quite rapid decreases in the money supply of around 20% and more. And they both occurred in around the late 1920s, early 1930s. And Friedman in particular argues that it was this rapid decrease in the quantity of money in circulation that led to the Great Depression of the 1930s, or as Friedman would prefer to call it, the Great Contraction. Now here we amend our basic regression equation so as to incorporate unexpected inflation as an independent variable. If we take I of t to be the consumer price index, then the logarithm of IT over I naught will be the continuously compounded rate of inflation over the period from 0 to t. Moreover, the parameter theta gives us the expected rate of inflation. So our regression model includes an allowance for the impact of the unexpected rate of inflation on the logarithmic variation in the money to stock price ratio. So here we have the results from applying our augmented regression equation. The constant term in the regression equation has a parameter estimate of 0.0742 with a t-statistic of 2.99. The speed of adjustment coefficient, which is 1 minus e to the minus b, has a parameter estimate of 0.0544 with a t-statistic of minus 3.39. The sensitivity parameter with respect to unexpected inflation is 0.8562 with a t-score of 3.13. The adjusted R-square is 0.0857, and the Durbin-Watson statistic is 2.01, indicating that there's no apparent problem with autocorrelation. Now, we have pointed out before that we need to check for the possibility of a unit root in this analysis. And we have done this by using what is known as the covariate augmented Dickey-Fuller test that was derived by Hansen in 1995. And when we applied this test, it showed that there was much less than a 1% probability of a unit root in our analysis. And therefore we can preclude the possibility of a unit root existing in these results. Now, an important question that we need to address here is how would an economic agent allocate their wealth between the stock price index and the holding of money? And we seek to address this by assuming that an economic agent wants to maximize the expected discounted utility of future consumption. Now, unfortunately, I don't have a great deal of time to go into this other than to give a snapshot of the results that can be derived. Now, probably the most important result relating to this model is summarized in the foot of the slide which now appears before you. And it shows that the proportionate investment that the economic agent will make in the stock price index is comprised of three terms. The first term is gamma naught e to the minus bt, and the gamma naught is the proportionate investment that the agent started with. And since it's multiplied by e to the minus bt, that will decay away to zero. The second term is multiplied by 1 minus e to the minus bt. And since again the e to the minus bt will decay away to zero, it gives the long-term proportionate investment, or the proportionate investment that the agent will be heading towards over time. You'll note that since alpha 1 is the expected rate of increase in the money supply, and sigma squared 1 is the variance of the rate of increase in the money supply has a very important influence on the proportionate investment that the agent will make in the stock price index. And as always, there will be stochastic variations in this proportionate investment, and that's captured by the term b over sigma 2 squared and the integral 0 to t at the end of that equation. So the statistical properties of the proportionate investment in the stock price index are summarized at the foot of this slide. We give its mean and its variance. And the empirical evidence that we have indicates for the period from 1871 to 2018 that the long-run proportionate investment in the stock price index will be about 80% of the economic agent's portfolio. Now, I want to conclude with a very short discussion about the way that derivative securities would be valued within the model that we develop in this paper. And I'd start by noting that we can use the fundamental theorem of asset pricing to determine a partial differential equation which will describe the temporal evolution of the prices of any or all of the derivative securities which might be traded in the economy. So we consider a derivative security that will pay out if and only if the money to stock price ratio is greater than 1, and it will pay off only if the exercise price, E, less the price of the stock index is greater than 0. This will mean that the option will pay out if and only if the money to stock price ratio is above its long-term mean, by which we mean the stock price index is undervalued relative to the quantity of money in circulation. And so we're dealing with a kind of put option here. Now, some rather tedious mathematics will then show that the value of the option will be given as in the next slide. Now, if you look at the valuation formula for the put option, which is summarised in the slide that now stands before you, you will see that there are two elements to the valuation of this option. The first involves the money to stock price ratio G, and the second involves the stock price index P. And you will in fact see that since we're dealing with a standard normal distribution function, that if either of the conditions G is greater than 1 or E minus P is positive, are not satisfied, that the option value at maturity will be driven to 0.